In fact, let's also continue that conversation with Rohit Saskeria, who is the fund manager, Equity Sundaram AMC, as well as Sumit Agarwal, the senior vice president, equity at Bandhan AMC. Thank you both for taking time out. Rohit, I wanted to get in a take from you then first up as to how you're looking at the implications really of what the upcoming rate cycle could mean for the banking sector as a whole.
Thanks. Good morning. So rate cycles, as we know, that rates have peaked out and rate cuts are just a matter of time. Whether it's immediately as October, December, or in Q4, we should be having some rate cuts following the Fed rate cuts. In such a cycle, generally fixed rate lenders like NBFCs and small finance banks tend to do better as their lending rates are fixed. And so when the borrowing rates go down, so their net interest margins will expand. So that's where we are positive on NBFCs and small finance banks, followed by PSU banks as they have a higher share of MCLR linked loans. So they will be able to protect their net interest margins better, while the larger private banks have a higher share of repo linked loans, which will face an immediate hit when the repo rate are cut.
Okay, fair enough. Let's get in your thoughts then as well, Sumit, as to how you're looking at what the outlook could be in terms of also the margins for some of these banking counters on the back of this.
I think a fair point made by Rohit and the earlier experts. But if you see, more than 50% of the book of most of the banks is external benchmark linked at the moment. So that is something which gets repriced almost within a month of the first rate cut. And on the deposit side, we should keep in mind that the CASA ratio of most of the banks today is not what it was a few years ago. A few years ago, we were at a peak CASA of somewhere around mid-40s, 44, 45% for most of the large banks, including private and public. But today, we are somewhere in late 30s or early 40s. And therefore, this piece, even if the rate cuts happen, will not lead to a lot of repricing on the deposit side immediately. And also at the same time, if you see, you also have to look at the share of shorter tenure of deposits, which is there on the bank's deposit book. So let's say something deposits maturing in, let's say, 6 to 9 months. And if you look at share of those deposits, probably private sector banks scores well here because they have slightly higher tenure of deposits which are maturing in the 6 to 9 months. And therefore, that can get repriced almost in a matter of 2 to 3 quarters, which will help in lowering down the incremental cost of deposits. So in a way, they are likely more cushioned to protect their margins. And while I agree that for PSU banks, they might have a higher MCLR linked loan book, but at the same time, on the deposit side, they somehow have a slightly longer tenure deposits. So their deposit book will get slightly take more time to get repriced. And therefore, I think in a nutshell, we'll have to go by each bank's case by case as to who will be better protected. But on the whole, I think probably private sector banks will be in a better position, at least on the deposit pricing side point of view.
Right. So I just wanted to understand, what, or rather, how would you then approach the banking sector right now? I mean, would you say that banks perhaps with higher fixed loans are going to be cushioned? Because we were just chatting with Sunil Mehta from IBA, and he was making the point that, that's not the case, because as a percentage, the floating rates are way higher than, fixed loan rates.
Yeah, that's right. So I think fixed rate, I think the data you presented somewhere ranging between 70 to 20%. But the EBLR linked loans are somewhere around 50%. So the way we should go about, especially from a portfolio management perspective, is to go with the time-tested methodology of paying respect to the valuations and then marrying it with the fundamentals. So if you see, probably private sector banks are trading at much better valuations versus their past history. And PSU banks did very well in the last 3 years, especially post-COVID. And today, if you see their ROAs or even their price to book valuations are almost at their long-term levels of 1.1% ROA and about 1.2 times price to book. Versus a private sector peers who are actually earning at least a 70 to 80 basis points higher ROA and a lower leverage, which is giving them an equivalent ROE. So in that context, from playing a portfolio, I would say that we should probably be inclined more towards having some exposure, a larger exposure to private sector peers, and probably be selective on the public sector piece as a whole from a portfolio management point of view.
Rohit, what's your own sense on who's better placed, whether it's the private banks or the PSUs?
Actually, both are looking quite good in terms of valuations right now. However, I would say PSUs have a slight edge compared to private banks, in my view, right now. Because, see, this cycle, it's a little different. We have to understand that PSU used to trade at a significant discount because of poor underwriting, and they used to consistently face asset quality pressures. Now, what we believe, most of them have learned from their past mistakes, and we are not seeing any new start of any new asset quality cycle right now. In such a scenario, where a PSU bank trades at roughly around 1 times price to book, as Sumit said, rightly in line with history, we believe there can be a scope for slight further re-rating here, while private banks are also cheap compared to their history. So there's enough scope to make money in private banks also.
Okay, fair enough. Also wanted to get in your take, Sumit, as to what the outlook is when it comes to Treasury valuations as well, because as we were discussing with Mr. Sunil Mehta, he said that this, rate cuts could potentially impact Treasury valuations. Is that something that you're anticipating too?
Yeah, see, normally when rate cycles move either upside or downside, there is impact on treasury valuations because they're mark-to-market loan losses and gains accordingly. So if we enter into a rate cut cycle soon, obviously there will be some impact on the mark-to-market on the treasury books of the loan of the banks. But we have to keep in mind in the earlier cycles, banks used to have a lot of NPAs and very smartly, some of the treasury gains were actually also used to actually provide for those bad loans. But today, the asset quality is quite healthy for the banks. So on an MTM, where while you will have some kind of probably positive impact, but on an accrual side, obviously, 10-year is already down materially. So you will have an incremental lower earnings on the other income side. But I think that all is part of banking cycles, and we have seen many cycles like this. So accordingly, what one should focus on is what is the hit to the ROA. And as of now, ROA seems protected for the banking system because there's neither a material impact on asset quality as of now, and the risk to the margins, as we all are discussing, as of now seems quite manageable.
Okay, Rohit, wanted to get in your take because, we were just talking about the overall view on what EPS estimates could, how they could be impacted. And do you think that perhaps valuations have already factored in that there could be a drive down in EPS estimates for some of these banks in this kind of a scenario?
No, I think valuations have kind of factored in, and the EPS estimates have baked in the rate cuts and their impacts on the bank. So I don't expect on the consensus expectations there will be a driving down on or EPS cut there. On the contrary, I believe the rate cuts can improve sentiments for the entire sector, as the sector has underperformed last year on the back of net interest margins coming off. Now, I believe as net interest margins stabilize, the rate cuts can provide the growth sentiments, and that can help this sector perform better going forward.
Sumit, in the near term, could there be a case that more than banks, NBFCs do better because they are the one who actually borrow from the wholesale market, and the impact for a wholesale borrower, it both in terms of the near-term profit move and also in terms of demand, could actually be higher. So, is there a case for NBFCs outperform before banks start outperforming?
Yeah, I completely agree with that. In fact, we have seen this every time when the rate cycle actually turns. And the nature of NBFCs, most of them being high proportion on the fixed asset side, fixed loan size like vehicle financiers, they tend to do well because not most of them are deposit taking, and cost of deposit is anyways high in the system. So you resort to wholesale funds for or CD issuances, or some those kind of borrowings, and that market is already in terms of the cost of the money is already trending lower. So incrementally, the spreads you earn on NBFC book is much more predictably higher vis-a-vis a bank where we are almost debating whether it will be good or bad. But for NBFCs, I think it's quite clear that that the spread should actually incrementally be better. In a way, that would also reflect in the stock price performance as it is always seen in the past, and in some ways also reflected in the recent 1 or 2 months performance of the sector as a whole as well.
Sumit, now if one looks at, let's say, interest rates come down, but what happens to the liability problem? Because that is not getting addressed, right? If interest rates come down, the deposits only will get repriced lower, and that will only make this entire shift of savings to stock markets or shift of saving to insurance slightly more and more less appealing for bank depositors. So the elephant in the room is not getting addressed. While we may start assuming that rates are down, banks will do well, the problem is something else.
No, fair point. I think we have been debating on entire flow of money outside banking system to the stock markets. But see, in some way or the other, the spread that you get on deposits vis-a-vis a GSEC, that spread used to be quite high historically. And in fact, if you look at the current last 1 or 2 years, that spread has actually narrowed down. So while obviously the kind of investor is very different for a stock market and an FD investor, but still you should be having a slightly meaningful spread over the GSEC to actually attract towards deposits from an investor's point of view. So I take that point, but in a way, banks are also resorting to a lot of CD issuances. For example, if retail is not growing, retail deposits is under pressure. If you see the kind of CD issuances that the banks have done in the past 6 months, it's quite high. So these kind of things always happen. Sometimes the CDs become cheap, sometimes NCDs become cheap, and sometimes the actual deposits also becomes cheaper. So we have to see how it plays out. And at the same time, as you rightly said, behaviorally, the feeling is that a lot of savings is flowing into markets. And if markets at the margin start giving you slightly lower returns, and the delta vis-a-vis the market returns and the FD returns also start shrinking, probably there might be some change in the behavioral patterns as well. But as we see, even today, deposits are just growing at about 11-ish%, and credit is about 14%. This is just about a 3% lead lag. And if this continues for a while, I'm slightly circumspect. If deposit doesn't improve, then there might be some hit on the loan growth as well as we end the year. So as of now, all of us are building about 14-15%. But if this entire unsecured loans and deposit pressure, if it continues, we might slip by another 150 basis points and end up growing at like 13.5% versus 14.5%. And in that scenario, probably PSU banks might not do well because let us understand that they are slightly higher levered for the same level of for an ROA which is about 80 bips lower. They generate a similar ROEs vis-a-vis private sector banks. And if credit growth at the margin comes down, then ROE will actually come off by a higher margin for them. And that's why I slightly differ from Rohit, and I have a slightly circumspect view on PSU banks from that perspective.
Right, gentlemen, both of you, thank you so much for taking the time out and joining us today, Rohit, Sumit, both of you.
Thank you.
If you like this video, then like, share and subscribe to ET Now.